Hi and welcome. So in this video we kick off chapter 9 of our macroeconomics 3 module, which will be looking at the financial markets and expectations. So our focus throughout this chapter will be on the role of expectations on the determination of asset prices, such as bonds, shares, and houses. So while this may sound like a topic that should be in the microeconomics section, since it looks at individual prices, there is a good reason why this topic belongs in a macroeconomics textbook. As you will see, not only are these prices affected by current and expected future activities, but they in turn affect decisions that influence current economic activity. So understanding their determination is central to understanding fluctuations. So the first asset price we look at is bonds, or rather the first asset we look at is bonds. So bonds are assets that promise a sequence of a fixed nominal payment. So bonds differ in two basic dimensions. One, default risk. This is the risk that the issuer of the bond, which could be a government or a company, will not pay back the full capital amount as well as the interest payment promised by the bond. And the second one is the maturity. That is the length of time over which a bond promises to make payments to holders over the bond. So in this section, we shall leave risk aside and focus on maturity. So bonds of different maturity each have a price and an associated interest called a yield maturity, or simply a yield. So yields on bonds with short maturity, typically a year or less, are called short-term interest rates, while yield on bonds with longer maturity are called long-term interest rates. So on any given day, we observe the yield on bonds of different maturities, and so we can trace graphically how the yields depend on maturity of a bond. So the relationship between maturity and yield is called the yield curve, or the term structure of interest rate. So this relationship can be shown in a figure like this. So this figure shows, for example, the term structure of a South African government bond at the end of the year 2008, and the term structure of a South African government bond at the end of 2009. So the choice of the two dates is not accidental. So why we choose them will become clear as we move forward. So one thing to note from this figure is that the yield curve was downward sloping, declining from a 3-month interest rate of 10% to a interest rate of 7%. This is shown by the declining curve of at the end of 2008, which is indicated here. So at the end of 2008, the yield curve was downward sloping, declining from a 3-month interest rate of 10% to an interest rate of 7.8% for bonds of 10 years or longer. So in other words, long-term interest rates were lower than short-term interest rate. This is shown by a yield that starts on a higher point and ends at a lower point, or has a negative or rather a declining gradient. So note that 1 year later, at the end of 2009, the yield curve was upward sloping. This is shown by this second curve here. So it was increasing from a 3-month interest rate of 7.3% to an interest rate of 9% bonds of 10 years or longer. So in other words, long-term interest rates were much higher than short-term interest rate, hence the positive gradient of the yield curve. So put another way, we can say that long-term interest rate were lower than short-term interest rate at the end of 2008, but higher than short-term interest rate at the end of 2009. So the question to ask now is, why was the yield curve downward sloping at the end of 2008, but upward sloping at the end of 2009? Or simply put another way, why were long-term interest rate lower than short-term interest rate at the end of 2008, but higher than short-term interest rate at the end of 2009? What were the financial market participants thinking at each date? So to answer these questions, we consider a price of the yield of bonds in different maturities. Firstly, we are going to derive the bond prices for bonds of different maturities. Then secondly, we'll go from bonds prices to bond yields and examine the determinants of the yield curve and the relationship between short-term and long-term interest rates. So in much of this section, we shall look at just two types of bonds. So one is a bond that promises to pay a payment of 100 Rand in 1 year. So a 1-year bond. And a bond that promises to pay 100 Rand in 2 years. So this is a 2-year bond. So once we've understood how their prices and yield are determined, it will be easy to generalize our result to bonds of any maturity. So let's start by deriving the price of the two bonds. So given that 1-year bond promises to pay 100 Rand next year, it follows that from section 14.4, where we learned about discounted values, that the price, which we call a RPP1T, must be equal to the present value of the payment of 100 Rand next year. So this is shown by equation 15.1, which shows that the price of the 1-year bond is equals to the discounted value of what is promised to be paid by the bond. So this equation basically tells us that the price of 1-year bond varies inversely with the current 1-year nominal interest rate. So how this comes about is already explained in the previous section where we learned about discounted values. So given that the 2-year bond promises to pay 100 Rand in 2 years, its price, it's called RP2T, must be equal to the present value of 100 Rand in 2 years. So the price of the bond is discounted. It's a 2-year discounted value of the bond, or what is promised to be paid by the bond, which is 100 Rand. So we simply discount the 100 Rand by the 2-year interest rate or interest payment that are promised by the bond. So this tells us that the price of the 2-year bond depends inversely on both the current 1-year rate and the 1-year rate expected next year. Okay, so let's explore these two equations further. But before we do so, or rather before we further explore the implications of equation 15.1 and 15.2, let's look at an alternative derivation of equation 15.2. So this alternative derivation will introduce us to the importance of a concept known as arbitrage. So arbitrage suggests that expected returns on two assets must be equal. So suppose you have the choice between holding 1-year bond or 2-year bonds, and what you care about is how much you will have 1 year from today. So which bond should you basically hold? So this concept of arbitrage will help us answer this question. So suppose you hold a 1-year bond. So for every Rand you put into your bond, you will get paid 1 plus the interest rate Rands next year. This relation is represented in the figure that we're going to explore just shortly. So secondly, suppose you hold a 2-year bond, because the price of the 2-year bond is RP2. Every rand you put into your bond buys you 1 rand over the price of the bond today. So, or rather 1 rand divided by the 2-year price of the bond today. So when next year comes, the bond will have only 1 more year before it fully matures. Therefore, 1 year from today, the 1-year bond will now be or rather the 2-year bond will now be a 1-year bond. Therefore, the price at which you can expect to sell it next year is now given by the expected price of a 1-year bond next year, which is given by this expression here. So for every rand you put into your bond, you can expect to receive 1 divided by the 2-year price of the bond times the next year's the expected price of the bond next year, or equivalently just the ratio between the expected price of the bond next year and the 2-year price of the bond. And this is represented in this figure here, which basically tells us that 1-year bond pays you 1 plus the interest rate next year, while a 2-year bond pays you the ratio of the 1-year expected price of the bond next year and the 2-year price of the bond next year. So this is the amount of what the bond pays you in 1 year, what the 2-year bond pays you in 1 year, and this is the amount of what the 1-year bond pays you in 1 year, which is basically its full maturity. So which bonds should you hold between the two? So assuming that as a financial investor, you care only about the expected returns and not the risk that comes with the investment, it will follow that the 2 bonds must offer the same expected 1-year return. That is, the 1-year return on 1-year bond must be equal to the expected 1-year return in 2-year bond. But if this condition is not satisfied, for instance, the 1-year return on 1-year bond is lower than the expected 1-year return on the 2-year bond, in this case, no one would want to hold the existing supply of the 1-year bond, and the market of the 1-year bond would not be in equilibrium, because the expectation is that it will give a lower return in 1 year compared to a 2-year bond next in 1 year, meaning that you can just hold a 2-year bond and sell it at a higher price in 1 year instead of just keeping a 1-year bond that will mature less in a year. So only if the expected 1-year return is the same on both bonds will financial investors be willing to hold both 1-year bonds and 2-year bonds, which is the concept of arbitrage. And let's explore it a bit further. So if the 2 bonds offer the same expected 1-year return, it follows from figure 15.2 that the return on a 1-year bond must be equal to the return in 1 year of a 2-year bond. Equation 15.3 states that the expected returns on 2 assets must be equal, and this is called the arbitrage relation, and can be rewritten as the arbitrage implies that the price of a 2-year bond today is the present value of the expected price of the bond next year, which is shown by equation 15.4. But this raises the next question, which is what does the expected price of the 1-year bond next year depends on? So the answer is straightforward. Just as the price of the 1-year bond this year depends on this year's 1-year interest rate, the price of the 1-year bond next year depends on the 1-year interest rate next year. Okay, so we'll leave it here for now, and we'll start explaining this conclusion, or rather concluding this concept in the next video, and continue with the concept of moving from bond prices to bond yields. All right, thank you.